actually have one topic I wanted to speak with you before. Did you see the Apple announcement about their new products?
I saw pictures of colorful computers.
Ah, yeah, it reminds me of the old iMacs, don't they?
Right, of course. Yeah, I had those in my third grade computer class.
That indicates your age. You're definitely someone of
I'm like right in the middle of the millennials.
the one I got really excited was the tracker. I was like thinking of like ideas of what it could be used for.
What's the
I'm
tracker?
like, the tracker is that little thing, metal thing that it's like Find My. You remember like the Find My iPhone?
Yeah.
But you can find the tracker. So if you attach the tracker to something, you'll be able to know where it is.
So it's like a tile. You remember the tile that went on
Yeah,
people's
it's going to
keychain?
compete against the tile. And immediately after like they announced that product, like antitrust like reviews show up because like
Yeah,
obviously Google. Sorry, Amazon, Apple. They're all the same. Apple has like enormous amount of power, so Tile is already like complaining, saying like, well, everybody's going to go to Apple because they want to remain. They're like
yeah.
excess market power, and they can do this. Blah blah. I've owned a Tile before. I don't want to download their app. It's too much effort. But these trackers, if it's the same app I'm using for finding my iPhone, it's like not as much effort.
Do you realize how hilarious of a statement that is?
I know it's such a lame one.
I don't want to download one more app so that you have to scroll over or search for the app name in order to do it. But kudos to Apple. Realize that's a real thing. I mean, I think most consumers have the exact reaction you have.
Yeah, so what's interesting is that it's not connected to the Wi-Fi. Sorry, it's not connected to the 5G network, right? Because otherwise it would require such a big battery.
Right.
It's only used by Bluetooth. If you're close to the tracker, then the tracker kind of activates and sends its location. You're close to my tracker and you have Bluetooth on, it will send the location of the tracker using your Bluetooth.
It's going to use someone else's iPhone to find your tracker?
Yeah, so it will use kind of your closeness to the tracker to be able to tell me where my tracker is. I was saying that Tile doesn't have that like network of iPhone, so it sends it anonymously. So it's such a big advantage. I could, let's say, leave a tracker in my bike, and somebody steals my bike, and then it goes by your house. It activates you. It will send the last location to your house. So I'll think it was you who stole my bike, but um, but that's kind of like the advantage of it.
I like that. It definitely Apple's got a great reputation on security. Like the iPhone has a very good security.
Can you imagine if Facebook came up with a Tile or like something like this, a tracker? Just get ads everywhere you go. Like if you search for like diapers and then you have the tracker on you and then you're going through Times Square, you just see like, do you remember that movie? Was it Minority Report? So one of those movies where like, I think it was Tom Cruise used to get like ads, personalized ads, like always as he was walking.
I don't remember that, but that checks out. If Facebook makes a tracker, yeah, 100%. On that thread, did you see the founder of Signal? You know the app Signal, the privacy focused messaging
I
app?
heard there was some Twitter news about it, but I didn't pay attention to it.
Yeah.
What's going on?
So he went after a company that makes iPhone busting hardware for law enforcement, basically. So like
got it.
Cops use this company to break open iPhones and get access to what would otherwise be encrypted data. Somehow Moxie Marlinspike, what an awesome name, the founder of Signal, got his hands on one of those machines, tested all the security of it, and found a bunch of security failures in the data, in the hardware that the cops were using. So I don't know, kind of like it's a big PR thing because he didn't do. There's like a traditional way to announce a bug in the community. zero day exploits. Yeah. There's a way to do it. And like kind of a protocol to alert vendors first, and he didn't do that obviously because he's kind of taken a little bit of a PR political stance against the vendor that sells to law enforcement. Yeah, but that's what I think of when I think of Apple tracking and like using other people's iPhones to track the trackers. I'm like, you guys better have that encryption all the way where you want it to be.
Oh, and then they said like if you can't really dump a tracker to someone else. Like if I dump a tracker in your backpack, like at the third day or something, it starts beeping because it can't just track you.
Interesting. They got to think through a lot of use cases like that, but
Like
I'm
I
sure they
think
do.
I have to be close to it at least once a day or something. Like that's some period of time. There's two topics that are on my mind constantly right now, specifically around investment, and it's the people are paying a very high multiple for tech stocks, and they don't realize that the compounded or like the sales that the company has to grow. I mean, the company has to grow an enormous amount of sales for them to have a good return plus the multiple return to historical levels. And so, because if the multiple is trading at like, let's say, a 40 times sales multiple, meaning that you're paying for every dollar that the company has in sales, you're paying 40 times that. And there are some of these tech SaaS companies that have that. And let's say long-term median sales multiples is 10, right? So you're going to go from 40 to 10. You're literally going to drop 75%, or what is it? It's 75%, right? Um, and and so the growth of the revenues not only has to be it's not 75%. It has to be much higher than 75%, but it has to compensate for that. And on top of that, you want a return. So you're talking about like a compounded annual growth rate that is going to have to maintain itself at a very, very high level for a long term. And that's, in fact, like in my opinion, it's very hard to predict that. Like if you don't have the visibility of that, you're literally throwing your money not away, but you're actually making a very, very, very long-term bet that I would say nobody can really predict. You're putting a lot of trust in somehow the system where the company operates and the people managing it. Everything will work out.
Agreed. I think that gets back to maybe a misnomer about investing that people don't. If you haven't been in it long enough or you haven't seen enough of it, you don't realize that you're not betting on when you buy a company stock, you're not just betting on the performance of the company, you're betting on the delta of the performance of that company versus the embedded expectations that's priced into it, right? Which is a little bit harder to do. And there are easy ways to back into this. This doesn't have to be like incredible deep research. You can do a quick analysis on these things in 10 minutes and see what the functional expected growth in sales is supposed to be, and then think about how big those numbers get. But counterpoint to the point you just made, the narrative that you just laid out, which is that some of these really big stocks are really expensive and the expectations are super rosy. Dude, I thought this in like 2015 or 2016 about like FANG stocks. I was like, my goodness, that the multiples on these expectations are absurd. There's never been expectations this high for companies this big, meaning that
Which year was this, you said?
For forever. You can functionally since the start of my career, I've bought into the value side of this narrative, which is that these big stocks are really, really expensive. They have to compound sales at insane rates on huge bases. And for a long time, they've done it. Like the big have gotten bigger and they've continued eating more and more of a TAM that we don't know how big the TAM is for like Google and Amazon. Like how big can it get? We don't really know.
Yeah.
So like, can they keep doing it? I don't know. But your point is, I think not everyone can.
This is what I'm telling people. And if you buy it at 40 times price of sales, like, yeah, good luck. You're probably going to have a 4% return, even if the company has a sales CAGR of 25. I don't know. It just doesn't make sense to buy at an expensive. I look at my portfolio. This was literally a post seeing this chart and then after seeing this chart. Post seeing this chart, I really like it. It motivated me to start getting rid of those high flying tech companies.
Interesting. Are you feeling okay? You sound like a value investor.
Yeah. So my goal now has been, an additional filter to my search
process.
Search process, which is like do not pay more than, I don't know, 6 times or 7 times price to sales ratio. Like you can't get a good return if you do that.
Quiz for you. Do you know what number 21 Deckers does? You know what their business is?
Isn't that clothing, like shoes and stuff?
Nailed it, dude. Good.
Yeah.
Good man. Good man knowing that.
You know which brands they do? I have no idea which brands they are.
Teva is one of them. Teva's the shoes. I can't remember what else. They do some like boots and other stuff. It's outdoor.
What's interesting is that
brands.
It's not all tech, right?
Right. That is definitely interesting. I would have thought 2006 especially. that this would have been super, super tech heavy. And it is. It's a lot, but not everything.
I would say 2012. I invested, or my clients' money also, a ton of money in Dentsply, which is dental stuff. I read this report that said, like, statistically countries that achieve a GDP per capita of like $12,000, $13,000 start at that point. It starts to the expenses in dental care grow at a double of the GDP at that point, right? Because people have more money, and where they're going to spend it. One of the first places is like the Hollywood smile. They want the Hollywood smile, so people start spending a lot of money, and that's why you see in those countries, you see like 20, 25-year-olds with like braces, right? In European countries or much wealthier countries, you see them earlier because people have money earlier, right? The parents have money; they just throw it at the kids' teeth. But in Brazil, for example, and like other countries, you see them at a much later stage, which was very interesting. So I bought Dentsply, but I should have bought Align. That would have been the better one.
You could get your thesis right and still miss. Yeah, no, I can attest to a lot of Brazilian rappers having braces specifically.
Yeah, are you into Brazilian rapper?
Kind of. It's a sort of like a little hobby. A buddy of mine that I study abroad with in Brazil, and I exchange the funniest Brazilian rap music videos we can find over text, like periodically.
That's funny.
It's fun.
That's kind of like where my mind is occupied right now, is trying to find like that additional filter. It destroys the amount of companies you can invest in. Like it goes from like 200 to like 30, right? And then on top of that,
especially in hot markets.
Yeah, but on top of that, it's like I'm not 100% sure the CAGRs will sustain over long periods of time, and that is the problem. Like the higher value companies, compounded annual return seem higher and seem more stable over long periods of time. Like I know, for example, Cloudflare or CrowdStrike will have a long runway of high growth. I don't know if Netgear will have it, right? So that's, and Netgear is trading at a price to sales ratio of like less than 1. And Ubiquity, which is the other company that does this kind of network mesh, they do it for more enterprise customers, but they're trading at a 13 times price to sales ratio. The margins are not identical, right? The margins are much higher, and Ubiquity, so it's part of that increase in price to sales ratio is justified by the higher margins that they are attaining in the business. But I think over time, Netgear has the possibility of increasing.
I'll tell you what's on my mind. I'm going to kind of weave two topics together. So I've been thinking about, I bring up crypto all the time on this, but crypto's got a lot of mind space, like a mind share for me right now. Recently been talking to people who have, crypto has created like an incredible number of new millionaires and new decamillionaires and new centimillionaires who come from the crypto world, right? So they're not, maybe they switch from traditional finance or from somewhere from engineering, wherever, and have some level of traditional finance knowledge. But many of them just kind of live in the crypto world, much more so than they do in the regular planning world that you and I do. So I want to answer one question, which is for people who generate a really big capital gain, what's a tax strategy to consider for that? So like, let's say you have, for example, $1 million gain on a crypto trade. First of all, congratulations. Good job on getting there. That's awesome. I hope it's life-changing in a positive way for you. Secondly, there is one thing that I would have you consider among many, many things that anyone should consider. Consult your advisor and your tax professional on all of this. But crypto gains are taxable. They're taxable as a capital gain. And there is a program under the 2017 Tax Cuts and Jobs Act called Opportunity Zones. You may have heard of this before. It was a pretty big deal when it came out because it was really new legislation and really changed the game. I'll try to be brief because it's really easy to get bogged down in the details. There's a lot of complexity here. But the short of this is, it still applies today in 2021. If you have a capital gain on anything, crypto, a business, a stock, anything, you can use this program called Qualified Opportunity funds. You'll hear QOF and QOZ both. There's differences. You can use this program to take the gains from that sale, reinvest the gains into one of these qualifying funds that does things in these qualifying zones, and defer the capital gain for up to, I think, 6 or 7 years. I'm not sure if the timeline changed based on it. A lot of it changed with COVID, so there's even extra complexities now. But you can defer paying the tax on that gain for a pretty substantial period of time, and invest in an opportunity zone, which is it's a compelling thing. It's attracted a ton of money, and it's worth, at the very least, if you're facing something like that, it's worth evaluating. I'm absolutely not advising you to go do this or not do this. I am advising you to evaluate and think this through and try and understand the tax advantages, benefits, the legislation behind it, etc.
My first question is, let's say I'm lucky, I had $5 million in capital gains sitting there, long-term capital gains, and I want to get rid of it. I'm done. If the company, I don't believe in the company anymore, or like the companies, can I sell that and start my own fund?
Yes.
How difficult would that be? Setting up all the paperwork.
I don't
there's lawyers who can do that.
Yeah, I don't know. I've seen someone, this is like from way back in the cobwebs of my brain, talk about something like $20,000 to $30,000 in admin and lawyer fees to start your own. And then probably a significant ongoing cost. I know the reporting requirements are pretty onerous for a QOF, a qualifying opportunity fund, to continue to stay eligible. They have very strict regulations about how they have to deploy their capital, on what time frames, et cetera. So you inherit a bunch of administrative stuff.
But the opportunity zones are there are zip codes or like areas within a zip code where you qualify for. If you buy a place there, if the fund buys a building, that would qualify. I think somehow like that, right? It's dependent on the zip code.
Yeah, so you're going to see a bunch of these marketed in real estate specifically. So real estate is probably the most popular way to take advantage of this. Real legislation isn't really specific to real estate, even though it does have some about that. It's about starting a business in these zones. So if you have an incredible startup idea, for example, and you want to go headquarter it in an opportunity zone in Detroit, and you think it's going to be a slam dunk, that can be a really, really good opportunity if you can fit that within the parameters. But for real estate specifically, the main thing to note is that you're not going and buying like a mature property at a reasonable cap rate that's in good shape and just turnkey buying it. You have to put significant capital upgrades into the property. I think to the tune of either 50, to the tune of either 50 or 100% of the purchase price. So so it's going to be a development deal if it's real estate. Mm-hmm. It has to be. And development deals are by nature riskier than buying mature real estate.
For me, the unattractiveness, and I have looked at pretty quickly, the unattractiveness was the fee structure. The fees are, obviously you have exceptions to that, but the fees in some cases are very onerous.
The fees can be onerous. It is. I heard a smart person, this is shout out Sam Lee on Twitter, wrote forever ago that this is a better opportunity for sponsors than it is for investors, because sponsors can get a lot of capital locked up for a long period of time. So to get these advantages, people have to hold for the beginning period of this 7 years. 7 years of potentially high fees accruing to a real estate sponsor could be really, really lucrative.
Yeah. How do you make sure that those gains are not taxed, the ones that you invested in? So let's say you have $5 million of gains and you invested in a fund. How many years does it need to be there in order to avoid all the capital gains when you get the money out?
That's a common misconception I've heard people mix up. You're not getting your original gain out tax-free. Mm-hmm. The original gain just gets a step up in basis, not a full step up, but a minimal. I believe it's 10% now. It went from 15% to 10%. I think. Don't quote me on that. But you get a slight step up in basis. So you really get deferral on your original capital gain.
Yeah.
What you get totally eliminated is if there's capital gain in the fund, that's zero. So again, the startup example is a really good one. So if you have a hot software startup, you can put it inside a qualifying opportunity fund. If you found it now, exit in 10 years, that can be totally tax-free. The capital gain on the opportunity zone investment can be tax-free.
But your initial gain that you had in there is just deferred, and you got a little step up in basis. It's not something I usually recommend. It's like a blanket recommendation is like, usually it's a no in my case. It's like, no, if you really think it's worth it, investigate further, but you need a lot more details to do that. The problem is like the lockup also. Like you lock up money. The classes of investments that you're making, most cases are real estate, right? In real estate, like the rental piece. What I've seen a lot of cases is that companies divide. Let's say they buy a building, but then they have they own the management part of that building. That the promoter, they take on the management fee and they take on the promotion and they take on just absorb all the gains.
Yeah, a sales commission. Yeah, there's a lot to unpack. And these, when you get the paperwork, if you're looking at these and you talk to a promoter and you get the paperwork, prepare to read 150 page PPM, private placement memorandum to look at these. One final piece on this to be careful of: if you're buying into one of these and it's a fund, like a diversified fund, if it's a limited partnership, which is common. Yeah. You're going to get a K1 from each state in which the fund has operations. So you could go from a simple tax situation last year to investing in one of these LPs and having a K1 from New York, from Florida, from Arizona, wherever.
Yeah.
So be careful.
I wonder why not do, if you own actually real estate already, and you're selling that in capital gains, you could easily do 1031 instead.
You can. 1031 is a little bit narrower because it's specifically for real estate, and also you have to match some amount of the debt structure from previously to the new investment.
Yeah.
And also you have to take your entire investment. So again, this is only the gain. So if you have some basis, you can take your basis out of your old investment and use it for whatever you want.
And then if you have a qualified small business company that you sell, that's the other part where
don't miss that one.
That's a much better one.
That's a totally better deal. QSBS is awesome.
Oh my god, like the venture capitalist just got the best deal of everything.
They did, and some early startup employees get it too, depending on when you get in. What is it, under 50 million
under
of
50
equity
million.
Value?
Yeah, so that's all what we have here for today.
I like it. That was a good one. I welcome you as a fully indoctrinated value investor now. It's great to have you over in the land of the grumpy old men and underperformers.